Again, I forgot to do the broadcast. A quick introduction of the Orbex's Traders Library. Please do check out Orbex, sign up for their email updates. They have brilliant market updates every single day to help with your trading. As for global market movers, guess what? In just an hour, we are going to have to hear the FOMC statement. They have been meeting. The Fed members, Janet Yellen and her gang, have been meeting for 2 days, and their statement is going to be out today. It's going to either shake the market or really not do anything to the market. So we're really anticipating this event. But before that, as I have told my followers, definitely try not to trade today before the FOMC for the simple reason of the fact that we really don't know what they're going to say. And it's always better safe than sorry. I am going to jump into details with this in a bit. But just so you know, and if you are here to day trade FOMC meeting, this is not what we're going to do today. We are going to have a more overall big picture overview of the global markets for investing, for more long-term investing. We are not going to day trade the FOMC meeting today, just in case you're here for that. If you do have questions, please feel free to type them in the chat box over here. I can definitely see it, and if we have time, I would try to go over your question and answer it for you. So without further ado, we are going to move to the U.S. economy. The FOMC rate statement, as I mentioned before, so today the Federal Open Market Committee are going to announce one of 4 different scenarios. We have 4 scenarios. One of the first scenarios is that the FOMC will not raise interest rates, but they will signal that they will raise the interest rates in 2015, which means in 2 months. We have only 2 months until year end. So if they do announce that they see a potential of raising interest rates next month, that would be a semi-bullish announcement for the US dollar. The second scenario for FOMC today would be they won't raise rates, but they would signal that they will raise interest rates in 2016, namely in March. That would be a semi-bearish signal for the US dollar, because the market participants who were pricing in an interest rate hike in 2015 will try to sell the US dollar and dump it. That would put downward pressure on the US dollar. Third scenario of the FOMC statement today is that they won't raise interest rates and they take the rate hike off the table altogether, saying the US the economy is too gloomy, there is no way we're going to raise interest rates. That would be a too damn bearish signal for the US dollar, and we could expect the US dollar to face a sharp sell-off. Last but not least, the final scenario for today's FOMC statement would be they will actually raise interest rates to 0.25%. Even though the possibility of that happening is pretty low, if they just decide to do it as a Halloween gift for the markets, that would be a too damn bullish signal for the US dollar. We can expect a knee-jerk to the upside in the US dollar versus all its major counterparts, and a potential shift in the market sentiment to the upside. So keep in mind, though, the reason why I've been saying that the possibility of a rate statement today is very low, one of the main reasons why that I actually think may have nothing to do with the U.S. economy at all. Do note that the Fed head Janet Yellen won't be holding a press conference after this month's meeting today. They normally do. So therefore, if they do raise interest rates, that is just going to be ridiculous that they raise interest rates and then she wouldn't hold a press conference right after it. And that's one of the main reasons why most analysts think there is no reason that Ms. Yellen won't have an opportunity to further explain to move at a post-meeting press conference. So there you have it. This brings down the possibility, if we even ignore the previous economic data coming out the U.S., this brings down the possibility of a rate hike even lower. Now let's take a little bit deeper look at the U.S. economy itself. The U.S. economy in the past few months, unfortunately, has not been posting really fancy schmancy data. The CPI fell 0.2% in September versus the drop that was expected. The U.S. consumer prices recorded their biggest drop in 8 months in September. That probably was because of the fall in gasoline prices. Last week, the Labor Department said that the Consumer Price Index fell 0.2% after slipping 0.1% in August. In the 12 months through September, the CPI was actually unchanged. But since this drop met the expectations, market participants took this as a positive signal last week, and that is the reason why we saw the minor upsides to the US dollar this week. In the jobs area, jobless claims fell to lowest level since 1973. That is definitely good news for the US dollar. The number of Americans submitting applications for unemployment benefits unexpectedly declined last week to match the fewest in 4 decades. That's huge. So why the heck, though, did the U.S. decline on that news last week? That might have to do with the manufacturing gauges, which showed slowing right after the jobs report. The two regional manufacturing gauges, the Philly Fed and Empire State, painted an identical picture in October, with both showing a sharp slowing in the industrial sector in the Northeast. So that could have been the reason why the U.S. dollar has been pretty choppy. So we've been having good news along with the bad news. But what about GDP? GDP, we have another announcement, the Q3 GDP coming up tomorrow. That is going to be huge as well. So what happened with the previous reading was that the GDP growth for Q2 in 2015 was less than expected, but it still came in a healthy 2.3% uptick, which is a solid improvement over the previous quarter's final reading of minus 0.2%. But looking at the details of the report, we understand that the main driver for the growth was personal consumption, expenditure, or the consumer spending, which increased by 2.9% versus the 1.8% in the previous months, which is good. The positive trade balance due to exports increasing faster than imports contributed to the jump in the advanced GDP readings as well. So overall, the GDP painted a pretty picture for the U.S. economy, and GDP is one of the most important gauges for a country's economy's health, which reinforced the idea that the rate hike is still a possibility this year in 2015 for the most part. So expectations, though, for tomorrow's GDP is that the advanced reading for Q3 2015 GDP would print a growth of 1.6%, which is less than half of the final Q2 GDP reading of 3.9%. So if you understand the numbers properly over here, that means a slower growth rate is to be expected. And while The reason why probably analysts are expecting a slower growth is because the available economic data is pointing for the Q3 months not being very impressive, with both consumer spending and industrial production in a turn down. Yesterday, we even saw the headline reading for September durable goods orders decline for the second consecutive month. It came out at minus 1.2% versus minus 1.1% expected, and the previous time it came out at minus 2.3%, and the core reading wasn't anything to brag about as well. The core was minus 0.4% versus the 0% expected. So as for tomorrow, if everything goes neutral today, no surprises, if you are looking to trade the US dollar tomorrow, how the US dollar reacts to the GDP really depends on the outcome. So a worse than expected reading would usually trigger a sell-off as a knee-jerk reaction, while a better than expected reading usually sparks a rally. And these, keep in mind, are short in nature, and you don't want to get too committed to them. You don't want to invest based on them. Today's statement, however, could signal an investing opportunity. Let me actually quickly go through an investing and trading. Investing is buying or basically getting into a position and holding. That is investing. Trading is buying and selling, selling and buying. All right? It's more short-term. For short-term trading, you want to look at monthly economic data, things that reoccur more often fundamentally, such as GDP, such as unemployment claims, such as consumer spending. For investing, you want to look at a big picture. You want to look at FOMC statement and how they are feeling about the economy in the long run, not in a short run. That is how you invest. That is why today's rate statement, after that, you may be able to find a direction for a long-term investment. After tomorrow's GDP release, you may be able to do a short-term, hourly, or day trade. All right, any questions for the U.S. economy up to here? I wanted to take a chance and welcome all the new attendees to our webinar. We are going to move on to oil and Canada. Oil has been taking an interesting route recently to the downside, although today we saw some upticking, and that definitely did affect the Canadian dollar. But what we want to do right now is taking an overall big picture outlook on oil. And the reason why oil, you might ask, why are we talking about oil when we want to talk about Forex? Oil is important, especially with commodity currencies such as Canadian dollar, also known as the loonie, because Canadian economy is very heavily how do you call it? Very heavily dependent on oil prices. And the positive correlation actually between oil and Canadian dollar has existed for such a long time. A 10-year analysis for the correlation between the two against the US dollar and oil prices has shown that there is a 0.78 positive relationship with a score of 1 indicating a perfectly positive relationship between oil and Canadian dollar. That is the reason why oil is important for Forex, especially if you are a loonie trader. This high correlation can be directly attributed to the way Canada earns US dollars and the percentage of Canada's revenue that this constitutes. So now taking a look at oil prices history, I actually forgot to bring the chart over here. Let's take a look at it online. Bear with me here. So I do want to show you the most recent Canadian dollar price movements. Over here, I actually covered the Canadian dollar versus the oil pretty massively and thoroughly. So this is the chart of crude oil. This is the chart of crude oil, well, 2 days ago. And as you can see, the oil prices were consolidating for over 3 years up until here. We had minor ups and downs. The range was between 108 and 84.80. And then we suddenly saw the massive drop in the middle of 2014, dragging the Canadian dollar with it. And it has been continuing well through 2015. We did have this bounce back hitting the 53.60 level on rumors about lower supply from the US and Iran sanction concerns, but it wasn't able to hold that level and is currently trading back below 50 again. So you might ask, why is oil prices dropping? Let me give you the background. What is the driver of oil prices? Surprise, surprise, it is supply and demand, right? So going back over here, supply and demand is a driver of any market for that matter. And the biggest addition to the oil supply family coming up would be Iran. Anybody familiar with this country? The country in the Middle East who has been under sanctions for a long time because of their nuclear activity. But the U.S., along with 5 other nations, have agreed to end the sanctions. And that would mean Iran is going to be able to export their oil once again to the international community. And bear in mind that Iran is one of the largest producers of oil, and they have one of the largest reserves of oil in the world, along with Saudi Arabia and the US, of course. So the Iranian official last week said that they had already secured buyers from Europe and Asia for over 500,000 barrels a day in new exports once the sanctions are lifted. That is a massive addition to the oil supply, to the global oil supply. And to top that up, Iran has also about 40 million barrels of oil in floating storage. So that is just a crazy amount of oil. So now you would want to know, okay, so what about demand? What if we have enough demand to push the prices higher? The answer is unfortunately no. There is no doubt that the global demand for electricity and battery or even hydrogen-powered vehicles have been growing, and electricity itself is now fueled by renewables other than oil. And at the same time, the oil demand for emerging markets in China has been going down because of China's, we're going to get into China a little bit more thoroughly in a bit, but China reported GDP of 6.9% for the third quarter, just below last quarter, 7%, so their GDP is going down. That means their demand for oil could be going down. So this is the first signal for Canada, for Canadian dollar, to be going lower. We do have a little bit more on that actually, as downgraded GDP forecasts for Canada. And as you know, and as we said before, GDP does have a direct impact on a strength of a country's economy and therefore for its currency. Canada did release better than expected GDP in September. That led to the strength of Canadian dollar that we saw in September versus the US dollar. But the Bank of Canada recently revised its outlook for their economy, and they decided to lower their growth forecast for 2016 and 2017. So again, we're talking long-term for investors. From their initial estimate of a 2.3% economic expansion next year, and 2.6 growth in 2017, it's now downgraded to 2% and only 2.5% in 2017. So that is a long-term bad news for Canadian economy. And well, the forecast led to a quick sell-off in the Canadian dollar, but of course, we've been seeing more ups and downs due to other things. We're again talking long-term with the Canadian dollar. Another thing you want to keep in mind about Canada is their new government. They just got in a brand new Liberal Prime Minister after a decade, and they are unlikely to do an interest rate hike, and they're also unlikely to do a quantitative easing to stimulate the economy. So these are, again, a little bit more bearish outlooks for the Canadian dollar. So now let's do a quick technical analysis for the Canadian dollar, let's say versus the US dollar, because we already covered the US. So here you can see the dollar CAD daily. Oops, we had a massive drop in dollar CAD. Right now, it actually happened in the past 4 hours. The reason why, again, as oil inventories, what happened in the past hours is that the U.S. inventory report showed a slightly small supply build, which means oil prices are going to go down. Iran talked about pumping more after sanctions, which is bullish, and there are efforts to convince non-OPEC members to curb productive oil production. But maybe one of the main reasons why oil prices went up today and therefore Canadian dollar has been extremely bullish has been thin liquidity. So for that reason, today we have seen a back down on a daily chart. But again, I wanted to take a look at a monthly, more bigger picture, basically, on the Canadian economy. So look at this. We have covered this before, haven't we? So going back to 2003, dollar CAD was on its highest highs at around 1.60. That is massive, right? Then we had the crash of 2017. It went back down to 0.93. It went up, forming the first top of a double bottom pattern over here in 2008, 2009 at 1.2530 level. Then it went back down, forming the second bottom of the double bottom pattern, and it is now on its way back up. And guess what happened in 4 months ago? The pair broke above and confirmed the break above the neckline. This yellow line that you can see here, which falls actually perfectly on the 50% Fibonacci level, this is the neckline of a double bottom pattern. If you don't know what a double bottom pattern is, I have produced a video on Orbix library about double bottom. It is a reversal pattern that changes a downtrend into an uptrend. So in a very, very long-term view, dollar CAD was in a downtrend, formation of a double bottom, confirmation above the neckline, and now we could expect in the long run, in the coming years, we're talking about 2017, we could see the prices going back up to with targets at 140 and 144. So you might want to ask, okay, so what's up with this month bearish movements? The answer is, well, any cycle consists of more cycles. And this cycle, we want to go back. If you want to technically, I already talked about fundamentally why that happened. That was because of mixed signals and better than expected signals from Canada. But technically speaking, it also makes sense because we want, after every massive, strong rally, you can expect a pullback. This happens all the time. Look, after this rally, we had consolidation, pullback, then another rally. Pullback, probably consolidation, then we can expect the rally to continue. And for the pullback, we can take advantage of Fibonacci retracement levels, which actually work again perfectly over here. The pullback stopped at 38%, went back up to 23. Now it's testing the 23% again. So this could actually turn into a double bottom over here if the prices are strong enough to break below 23%, or if the FOMC comes up with a very bearish signal today, we could see the market go down to 38% once more, regain energy, form another minor short-term double top, and then shoot back up. So there you have it. That is dollar CAD for you. Next, we would like to go ahead and cover the next important economy in the Forex market, which is, drum rolls, Eurozone. Anybody from the Eurozone today in the audience? Roman, your name sounds a little bit European. I just did a stereotypical analysis over here. So for any Europeans in the house today, let's take a look at the most recent ECB statement that surprised the markets. So for those of you who didn't hear it, the ECB announcement of last Thursday was a downbeat. And what happened was that Super Mario, also known as Mario Draghi, the head of ECB, grabbed the mic and sent out clear signals that they are ready to do a quantitative easing. And even though the ECB policymakers agreed to sit on their hands and keep monetary policy unchanged for the time being, Super Mario confirmed during the press conference that they are very much prepared to increase the stimulus soon. In particular, he shared that the committee will re-examine the degree of monetary policy accommodation in their December meeting. That is year-end. So that means we could get a downbeat bearish movement as a Christmas gift from the euro. By then, ECB officials and Forex market watchers will have a fresh batch of data to pour over, including revised quarterly growth and inflation forecasts from central bank's economic staff. So we better pay close attention to the CPI estimates, as another negative headline reading could basically seal the deal for more quantitative easing for European Central Bank. Another bearish or downbeat signal we got from ECB was a potential rate cut. And that had to do with increased bond purchases. For that, Mario Draghi hinted that the deposit rates could be dragged much lower. And keep in mind that the ECB already implemented negative deposit rates in June in 2014, which meant that banks actually had to pay in order to park cash in central banks' vault and to stimulus lending activity. This was followed by another rate cut in September 2014 to minus 0.20%, which Draghi said was already the lower bound. Back then, the ECB had assured that deposit rates couldn't possibly fall any further, but now he's saying that circumstances have changed. So again, very bearish stuff coming out from the euro. Another thing, as those strong hints about further QE and deposit rate cuts weren't bad enough for the euro, Draghi also pointed out that he'd like to see a much weaker currency. In fact, he said that the euro's recent gains pose downside risk to growth and inflation. After all, a strong local currency makes exports more expensive and imports cheaper, weighing on trade activity and domestic price levels. So there you have it. 3 signals that the euro could be going down as soon as December 2015. And we actually already saw the drops. We are going to do a quick technical look at the euro versus the dollars. So one other takeaway, though, from ECB was that the downturn in China and the emerging markets. And of course, every economy has been complaining about this for the past few months. The Eurozone, though, is one of the weakest in the global economy when it comes to fundamentals, because the region has struggled to get back on its feet earlier this year, and the economic footing has not been very stable yet with all the stuff happening in the Eurozone, which means that it's still vulnerable to external risks, such as China. We are going to cover China extensively in a minute. But one thing that Mario Draghi said, and I'm quoting, while euro area domestic demand remains resilient, concerns over growth prospects in emerging markets and possible down pressures for the economy from developments in financial and commodity market continue to signal downside risk to the outlook for growth and inflation in the Eurozone. So staying in a wait-and-see mode for the ECB seems to have gotten to mainstream for Mario Draghi, and they seem to be ready to act if needed, and they're open to a whole menu of monetary policy instruments. And as a part of his forward guidance, Mario Draghi said that the relevant committees are already in the process of examining the ECB's options for policy easing. And he even shared that a few governing council members have expressed their preferences for additional stimulus this week, hinting that most ECB policymakers are in agreement that the region could use more help. So to sum it up, the ECB monetary policy statement was a decisively dovish statement, and even more so compared to the earlier rate decision. So these remarks, I am actually going to take a look at technicals over here. These are enough to spur a long-term breakout on the Euro Forex pairs, and a strong downtrend could be in the cards. And of course, this still could depend how the upcoming economic data turns out. So we always have to be in touch and stay tuned for further economic data. But I talked about the technical, bearish technical signal that recently formed after Mario Draghi's announcement was right over here. We're looking at the euro-dollar daily chart. I apologize for a lot of, we have the Ichimoku cloud over here. We have a lot of moving averages. Let me actually get rid of a bunch of them so that you can see a little bit more clearly. Okay. I still don't know how to. All right, maybe we'll keep it. Okay. This is, hold on. All right, so just so you know, this is the Ichimoku cloud over here. We have a bunch of moving averages, and I'm going to point out the important level that the market, this is the day, this candlestick right over here, you see the strong bearish candlestick on the euro dollar. This happened on Mario Draghi's statement after the ECB statement. And this was strong enough. Last week, in last week's webinar, for those of you who are here, we talked about this very important level, the 111 level in the euro dollar, and that the market had been trying to break below it for many times since August, since the China slowdown, but it wasn't able to do it. But the ECB statement was strong enough to not only test and break below the 111 level, but also confirm a break below it. Not only that, it also broke below the Ichimoku cloud right over here. You see, this is the Ichimoku cloud. A sharp break down below the Ichimoku, a confirmation below a key support level. Now we're seeing a little bit of a pullback, probably on fears on the FOMC, but this could be the beginning of a new era in euro dollar. If we don't see a complete shift in the market sentiment, which was a range, the market, just so you know, was ranging within this channel. Hold on one second. I really need to get rid of this one. Delete all arrows. We're going to delete this one. We're going to delete this one. We're going to delete the Fibonacci. Hold on one second. This takes a little bit of a... Okay. Alright, I must admit it is very hard to get rid of stuff over here. Let's see, if we go to insert, if we go to train oscillators, Ichimoku Kinko, no, there is no way we can do that. Okay, anyways, what I wanted to show you was this range in the prices. It is a little bit hard to see with all the moving averages we have on top of this, but I'm sure you can appreciate the range. So if anything, what Maria Draghi's comment did was bringing down the range from 115 to 111, one level lower, to 111 and 108. So our next bearish target is 108, extended target remains at 106, and furthermore, and obviously a break below 104 would open doors for parity. That is 1 and 1. All right, so there you have it. We have strong bearish signals for the euro dollar. In today's, in my article yesterday in Investiva, I encouraged the forex traders not to trade the euro dollar ahead of FOMC, though. All right. The only reason why is that we don't know what's going to happen with the FOMC meeting. Once that's off the table in the long run, we have a heck of a bearish signals over here. Maybe this is more visible for you guys over here. This is the euro dollar daily. This is the channel I was talking about. There you have it. And these are their levels and support levels. So we have 109.50, we have 108 as short term. The market already broke below a rising channel in the range, below the 111 support level, and below Ichimoku cloud. So with that in mind, after I would say in about an hour, the statement is going to come out in 20 minutes. Wait for the markets to calm down, probably an hour or two, and then decide if the market is still bearish. That would entail a semi-bullish or a bullish outcome from the FOMC, and then you can get into a bearish euro-dollar trade. Okay, so that's that for euro. We have 15 minutes, and I would like to cover China, the problematic China, full of surprises China. So what the heck is going on in China, and what are they doing about it? Their central bank decided to drop another bombshell on the forex market right before the weekend last week, and they announced several rate cuts. That's the 6th time they've cut interest rates since November last year. And you probably know that the Chinese economy has been in the middle of a slowdown for the past few months, and the inflation has tanked. GDP growth is at its weakest pace since 2009. Import and export activity have tumbled, and its stock market has dropped like it's hot. This is pretty huge because even though we don't trade the Chinese currency, the Chinese economy is the second largest economy in the world. So what happens in China does not stay in China. So what are the authorities of China doing about all this problems going on? The People's Bank of China, the PBOC, lowered its benchmark interest rate from 4.60% to 4.35% in order to boost liquidity through cheaper borrowing costs. Aside from that, the central bank also decided to cut the deposit rate from 1.75% to 1.50% and to reduce the reserve requirement ratio by 0.50% to spur lending activity. Right? So prior to this, the PBOC had already announced a reserve requirement ratio reduction in 4 instances since November last year in hopes that lowering the amount of cash that banks are required to keep in central banks' vaults would mean that they'd have more money to lend to consumers and businesses. The Chinese government has also acted to devalue the yuan, their currency, in order to stimulate demand for exports and keep domestic price levels supported. After all, a weaker local economy enables China to hit 2 birds with 1 stone. 1, it makes the country's product relatively cheaper in the international market. And 2, it makes importing goods more expensive. So that means people are going to buy more domestic stuff, right? So all these, so the question here actually basically would be that, will this easing efforts be good for China and the global economy? Well, obviously China is thinking that this will be good for the Chinese economy, and the Chinese economy has been in a severe need of stimulus for the past few months, so there's no surprise that the Asian equities reacted positively to that rate cut. Besides, most central banks have been blaming the Chinese slowdown for bringing up, as we said, the ECB is among them. The China slowdown basically brings uncertainty to other economies' problems. So these easing moves could provide a bit of a relief to global economy as well. But the fact that Chinese authorities have been announcing one rate cut after another in the past few months suggests that these monetary policy tools might already be losing their effectiveness. The more you do it, the less surprise you get, right? Chinese government officials are still set to convene later this week and to come up with policies and reforms for the country's 5-year plan, and that could definitely affect the forex market trends. How? For now, it looks like the rate cuts were enough to revive risk appetite because high-yielding assets went up after that announcement. Commodity currencies such as the Aussie and the Kiwi were also in good spirits at the time, since the additional liquidity could lift prices of oil and precious metals. We may be able to talk about Australian dollar, but in particular, the Aussie has been able to regain ground against the other forex peers on the Chinese rate cuts because more stimulus in China could shore up demand for Australia's iron ore exports. China is Australia's biggest trading buddy. So moving forward, the Forex market watchers are likely to keep close tabs on whether these easing efforts will be able to steer the Chinese economy towards a recovery or not. So we have more to go with China and probably more surprises coming up. Signs of progress could allow the central bank officials to breathe a little bit, and signs of slowdown could just bring more turmoil in the global economy. So the question here now remains, will the Bank of China keep their risk appetite in play and cut more of their interest rates? So there you had it, China and the Forex market. Last but not least, we are going to cover the UK economy. UK has been having an interesting journey because 2 months ago we were very upbeat about them. Now we're seeing some down moves, especially against the US dollar. So it has been very interesting. So let's dig and see what has been going on in the UK. We're going to take a look at their growth, employment, consumer sentiment, business conditions, and inflations. All right. So generally speaking, the British pound has been doing rather well against other Forex counterparts, except for the US dollar and the Kiwi. Demand for the British pound is usually attributed to positive merger and acquisition stories, such as the one between the two big companies over there that I actually don't know how to pronounce their names, so we're going to skip that one. Another major factor keeping the British pound high and up is the Bank of England, who is still set to hike their rates by Q1 or Q2 of 2016. So let's though take a look at the underlying fundamentals to see if that supports a potential rate hike that the Bank of England has been talking about. Taking a look at the growth, the final reading for Q2 2015 GDP growth was unrevised at 0.7%, which is a welcome improvement for the previous quarter's 0.4% expansion. However, the year-on-year reading wasn't that upbeat because it only registered at 2.4% increase, which is slower than the previous quarter's 2.7% increase, and also happens to be the slowest growth in 7 quarters. Looking at the details of the GDP report, the slower annual growth was due to the 3.4% increase in gross fixed capital formation, which is the net new investments in fixed assets such as roads and hospitals and bridges. And that was much lower than Q2 in 2014, which came out at 4.9. So we have 3.4% this year versus last year 4.9%. On a quarterly basis, the increase was due mainly to the 1.4% contribution from the positive trade balance that could have been attributed to increase in exports and contraction in imports. Other components had minimal contributions, but household spending continues to be the backbone of British economy with its 0.5% positive contribution to the GDP growth. The main drag to the GDP was from the 7.1% drop in gross fixed capital formation, which subtracted 1.3% from total GDP growth. So there we have a good news and bad news when it comes to GDP. Long term, not really good news. Short term, not really bad news kind of thing. As for employment, the other major impact on a economy, the forex traders and the prices reacted positively to the most recent employment readings because the current jobless rate of 5.4% is the lowest level in 7 years. Also, the employment rates climbed to 73.6%, which is the highest ever on the record of the UK. To top that off, the average earnings index, which is the main gauge for wage growth in the UK, grew by 3%, while the labor force participants rate remained steady at 77.9%. So overall, employment has been painting a pretty good picture this month. The only disappointment was the claimant count change, since it saw a 4.6 thousand increase in the number of people claiming unemployment that could potentially come around and bite economy, their economy of the UK in the buns. But overall, the UK has been pretty solid when it comes to employment. So we covered GDP, which has been neutral, employment, which has been to the upside. Consumer spending. A lot of people, a lot of forex traders were actually blown away when the UK printed a much bigger than expected increase in retail sales volume for the months of September, since we apparently underestimated the huge increase in food and beer sales due to the Rugby World Cup. So there you have it. Sports actually contribute to a country's economy. So the knee-jerk reaction to the surprise reading was to send the pound higher, but the forex trader later began unwinding some of their position when they got the surprise increase. They got the information that increase was due to the Rugby World Cup, and the UK official for national statistics mentioning in the report that the feedback from food stores suggested that some of the growth can be attributed to promotions centered around Rugby World Cup. So that means forex traders basically come to the conclusion that this spending cannot be sustained, because how many Rugby World Cups are you going to have a year? Only once, right? So the moral of the story is that we could see consumer spending to actually go down in the next readings. On an annual basis, the sudden surge in the retail sales also had a significant impact, pushing the reading to a 10-month high of 6.5% versus last time's 3.5%, almost double. So when it comes to consumer spending, basically the numbers are at odds with the surge in consumer spending for September because it dropped by 4 points, with most indices seeing slight decreases. The major purchase index, for example, dropped by 3 points. But interestingly, the savings index actually posted a single point increase to 3, which implies that the Brits are a bit more inclined to save nowadays. One more to go is business sentiment and conditions. The total industrial output in August advanced by 1.9% on an annual basis and 1% on a monthly basis, mainly due to mining sector, which went up by 17.7%. The manufacturing sector saw a 0.8% decrease. And the upcoming readings for manufacturing production probably won't see an improvement because the markets manufacturing PMI for September went down to a 3-month low. Inflation. Both the monthly and yearly readings for headline CPI in September dipped back into negative territory. The main drag of the year-on-year reading was the clothing and footwear component, which dragged headline CPI down by 0.09%. Monthly readings, lower oil prices are a considerable drag since the 2.9% decline in the fuels and lubricants allowed the transportation index to drag the entire CPI reading into the red territory. To sum it up, with 2 minutes left of this webinar, aside from further tightening in the labor market, most of the other economic indicators aren't really that optimistic, particularly the inflation and the CPI. The Bank of England, though, did warn in its latest meeting minutes that the CPI would likely remain close to zero before picking up around the turn of the year. There was also a sudden surge in retail sales, but it was likely due to Rugby World Cup. So we'll probably see some normalization in the coming months. And okay, so these are great and all, but the question now, which I asked at the beginning of this section, was that are we set for a rate hike in the UK? On the surface, it's rather difficult to justify a rate hike, but coming from the meeting minutes and individual speeches that have consistently showing that a likely path for rate hike, we could expect it is basically still on the table for the UK. Some analysts in particular has been voting for a rate hike because they believe that rates aren't even raised. If the rates aren't raised soon, there is a good chance inflation will overshoot the Bank of England's 2% target. And the solid domestic consumer spending and steady increase in wage growth certainly supports this view. So there you have it, the global economy overview. If you do have any questions, please go on to orbix.com. Send your questions over there if you would like to hear more from me. Take a look at investiva.com. Invest responsibly, and hopefully I will see you in our next webinar. Thank you so much.